Hello everyone, welcome back to FinStack Academy. I'm Uday Churi. In our previous lesson, we learned that businesses record financial transactions. But today, I have a simple question for you. Should a business record a transaction only when money changes hands? Or should it record the transaction when the business activity actually takes place? Believe it or not, this one question led to two different methods of accounting: cash basis, accrual basis. By the end of this lesson, you will clearly understand the difference between them and why almost every large organization follows the accrual basis of accounting. Let's begin with two simple business situations. I don't want you to think like an accountant yet. I want you to think like a business owner. Imagine you rent an office. You use the office throughout the month of May. The landlord says, "That's fine, you can pay me on the 5th of June. Now, here is my question. In which month do you actually use the office? May. Correct. Now, in which month did you make the payment? June. So, should the rent expense belong to May or June? Take a moment and think. Let's look at another situation. You sold goods worth 50,000 to a customer on 10th May. The customer promises to pay after 2 months. The money finally arrives in July. Now think carefully. When did you actually earn the revenue? Was it in May or only in July when cash arrived? Pause and think. These two questions are enough to understand the difference between cash basis and accrual basis. Let's first understand the cash basis. Cash basis follows one very simple rule. If money comes in, record the revenue. If money goes out, record the expense. No cash, no accounting, simple. Now, let's apply this to our rent example. The office was used in May, but payment happened in June. Under cash basis, the expense gets recorded only in June. Nothing appears in May. Now ask yourself, does that really show what happened in May? Not really. Now let's look at accrual basis. Accrual accounting follows a completely different thought process. It says, I don't wait for cash. I record transaction when the business activity happens. So, office used in May, expense belongs to May. Goods sold in May, revenue belongs to May. Cash may come later. Here is another example. Imagine you have worked the entire month. Your salary is credited on the 5th of the next month. Would you say, I have not earned my salary yet because the money has not come? Of course not. You have already earned it. You are simply waiting for the payment. That's exactly how accrual accounting works. Now, the comparison table becomes much easier to understand. Cash basis focuses on cash movement. Accrual basis focuses on business activity. Cash basis is simple to maintain. Accrual basis is more accurate because it shows what actually happened during the accounting period. That's why most small businesses may use cash basis while medium and large organizations generally follow accrual accounting. Every difference you see in this table comes from one simple idea. Cash basis follows cash, accrual basis follows business activity. Many beginners think accruals are only related to expenses. That's actually not true. Accruals apply to both expenses and revenues. Let's look at two situations. Employees have already worked, salary has not been paid. That's an accrued expense. Now consider another example. A consulting company completed a project for a customer. The work is finished, but the customer has not paid yet. That's accrued revenue. So remember this simple rule. Whenever the business activity has already happened, but cash has not yet moved, an accrual may be required. You may now wonder, why do accountants go through all this effort? Why not simply record cash? The answer is very important accounting concept called the matching principle. Let's understand it with a simple example. Imagine you write your final examination today. Your answer paper is evaluated this week, but the results are announced next month. Now think carefully. When did you actually earn your marks? Was it when the results were announced? No. You earned them when you wrote the examination. The announcement simply informed everyone about something that had already happened. Accounting follows the same logic. Revenue is recognized when it is earned. Expenses are recognized when they are incurred. This ensures that the financial statements show the true performance of business for that period. Now, let's put everything together. This slide shows the complete journey of an accrual. Step 1. Business activity happens. Imagine we are in the month of March. Employees have worked throughout the month. Their manager congratulates them. Excellent work, everyone. The project has been completed. The company also says, we will process your salary on the 5th of April. Notice what is happening. The work is already completed, only the payment is pending. The same thing happens with electricity. You have already used electricity throughout the March. The bill has not arrived yet. Or think about a consultant. The project has been completed. The customer will pay next month. In every one of these situations, the business activity has already been happened. Only cash is waiting. Step 2. Recognizing the transaction. Now it's the 31st of March. The accountant is about to close the books. Before doing that, the accountant asks one simple question. What belongs to March? Employees worked in March, so the salary expense belongs to March. Even though payment will happen later. That's why the accountant records salary expense debit to salary payable account. Similarly, if services have already been completed, the revenue is recognized now, even if the customer has not yet paid. Notice something important. Still, no cash has moved. Only the accounting records have been updated. Last and final, step 3, settlement. Now, April arrives. Employees receive their salaries. Should we record salary expense again? Absolutely not, because we already recognized that expense in March. April is only settling the amount that was payable. Similarly, when the customer finally pays, we don't recognize revenue again. Revenue was already recognized earlier. We simply converting an amount receivable into cash. That's why you will notice something very interesting. March records the business activity. April records the cash movement. The two don't always happen together. So let's summarize today's lesson. Every transaction has two important events. First, the business activity happens. Later, cash moves. Cash basis records transactions only when cash moves. Accrual basis records them when the business activity happens. If cash comes later, accounting temporarily creates a payable or a receivable. When cash finally arrives, these temporary accounts are either settled or reversed. And that's the complete life cycle of an accrual. Remember this one sentence because it captures the entire lesson. Business happens first, accounting recognizes it, cash settles it later. If you understand this one line, you have understood one of the most important concepts in accounting. And that's a wrap for today's video. I hope this session helped you clearly understand the difference between cash basis and accrual basis of accounting, along with the complete life cycle of an accrual. If you found this video useful, please give it a thumbs up, subscribe to Finstack Academy, and hit the notification bell so you don't miss our upcoming videos on accounting, finance, and ERP. If there is a topic you would like us to cover next, let us know in the comments below. Thank you for watching, and I'll see you in the next video.